It does not feel like a crisis when it starts. It feels like a Tuesday night decision. The grocery bill came in higher than expected this week, $40 over budget, and the checking account is running thin. The mortgage payment clears on Friday, so you do what millions of Canadians are doing right now at kitchen tables across the country. You reach for the credit card, you tell yourself it is temporary. You tell yourself you will pay it off next month when things settle down. You swipe. The transaction clears. The groceries go in the fridge, and somewhere inside a data center operated by one of Canada's largest financial institutions, an algorithm just recorded that moment. It logged the date, the amount, the merchant category, and the current utilization rate on your card. It compared that data point against your payment history from the previous 18 months. It ran a predictive model, and it quietly updated your internal risk score. You do not receive a notification. You do not get a warning. The bank says nothing, but the clock has started. Welcome back to Canada Property Watch. Over the past several weeks, we have pulled back the curtain on the machinery dismantling the Canadian housing market piece by piece. We exposed the negative amortization trap, growing the mortgage balances of 420,000 Canadians, while they paid faithfully every month. We documented the insurance blacklist triggering automatic mortgage recalls. We tracked the forensic audits catching fake income documents from the boom years. Today, we are going deeper into something that the Bank of Canada itself published in its most recent research cycle, and that almost no mainstream outlet has explained in plain language to ordinary homeowners. It is a landmark analysis drawn from 9 years of TransUnion credit data covering 9 million Canadian mortgage holders. And what it found should be read by every person in this country who carries a credit card balance and owns a home. Because what the Bank of Canada has now officially documented is a precise 2-year countdown, a sequence of financial behaviors that precedes mortgage default with such consistency and such predictability that the researchers describe it as a robust suite of early warning signals. The banks are reading these signals right now in real time. The question is whether you are reading them too. And to understand the significance of this research, we have to understand who commissioned it and why. The Bank of Canada does not publish consumer finance guides. It does not release reports to help individual Canadians manage their household budgets. Its mandate is monetary policy and financial system stability. When the Bank of Canada publishes a paper specifically tracking the behavioral patterns that lead to mortgage default, it is not doing so out of concern for the family sitting at their kitchen table. It is doing so because mortgage liabilities represent the single largest component of household debt in Canada and are the most critical variable in monitoring systemic financial stress across the entire banking sector. The bank is building a surveillance framework, and it is identifying the early warning signals so that regulators and lenders can act before the losses become systemic. The paper is not a wellness guide. It is a risk management tool built for institutions. And understanding how that tool works gives you an extraordinary window into how the financial system is currently assessing your household right now without your knowledge and without your consent. Let us build the timeline. Let us follow a family through the 2-year countdown that the Bank of Canada has now mapped with clinical precision. Let us call them Michael and Karen. They bought a semi-detached home in the suburbs of Toronto in early 2022 for $1.1 million. 5-year fixed mortgage at 2.9%. Monthly payment of $4,100. Combined household income of $155,000. And at the time of purchase, the payment represented just under 32% of their gross monthly income. Tight but manageable. They were optimistic. The market was rising. Their equity was building on paper. They felt like they had made it. By late 2023, the landscape had shifted beneath their feet without a single dramatic event to mark the change. Inflation had consumed a significant portion of their purchasing power. Grocery bills were running 30% higher than 2021 levels. Car insurance had increased substantially. Utility costs had climbed. Michael had not received a raise that matched the real rate of inflation. Karen had reduced her hours to manage childcare costs after daycare fees increased beyond what the government subsidy covered. Their monthly surplus, the money remaining after every fixed expense was paid, had contracted from roughly $2,200 to approximately $800. They were not in crisis. They were not missing payments. They were not behind on anything, but the buffer was gone. And a household without a financial buffer is a household that is one unexpected expense away from the first signal. Signal 1 begins quietly, and it begins reasonably. The credit card starts carrying a small balance from month to month. Not the full statement balance, just a portion. $300 one month, $500 the next. The card has a $12,000 limit. The balance never feels threatening at these early levels. The utilization rate moves from essentially 0 to around 15% over the course of 12 months. To Michael and Karen, this feels like normal life management. The credit card was marketed to them as a tool for exactly this purpose. The rewards program encouraged them to put everything on the card. The minimum payment system was designed by the issuer to keep a balance cycling indefinitely. Carrying a small balance does not feel like drowning. It feels like using a product as intended. What the Bank of Canada data reveals is that for households that eventually default on their mortgage, this pattern of rising credit utilization begins approximately 24 months before the default event. The utilization curve starts its slow climb upward, while the mortgage payment continues to clear without interruption month after month. The mortgage is fine. The signal is not the mortgage. The signal is the card. The Bank of Canada researchers found that credit utilization remained essentially stable for non-delinquent borrowers during the same observation period. The divergence between the two groups begins at the 2-year mark and widens consistently as the default event approaches. This is not a pattern that applies to financially reckless households alone. The research covered 9 million mortgage holders across Canada. The households that entered the countdown were not outliers. They were statistically representative of the middle-income homeowner demographic. They were people with good credit scores at purchase, people with stable employment, people who followed the conventional financial advice they were given. The vulnerability was not a character flaw. It was a structural consequence of buying at peak prices with peak leverage into an inflation environment that the Bank of Canada itself failed to anticipate correctly. Signal 2 arrives between 1 and 2 years before the mortgage default event. This is the moment the pattern shifts from concerning to dangerous. The missed consumer credit payment. For Michael and Karen, this moment arrived in the spring of 2024. A car repair bill came in at $2,800. The checking account could not absorb it without leaving the mortgage payment at risk. The credit card minimum payment was due on the 15th. Michael transferred money from the line of credit to cover the repair and missed the credit card minimum by 4 days. It was not a decision to stop paying. It was a timing miscalculation in a month where every dollar had an obligation attached to it. The late payment was recorded by the credit bureau. His score dropped 18 points overnight. He called the card company, explained the situation, and they noted it as a one-time exception. He assumed the matter was resolved. What he did not know is that the exception notation lives in the same file as the delinquency flag. The bank system recorded both. The Bank of Canada research identified a specific sequencing to the consumer credit delinquencies that precede mortgage default. Credit card missed payments appear first in the timeline, typically 12 to 18 months before the mortgage event. Auto loan delinquencies appear next, then HELOC missed payments, then lines of credit. There is a hierarchy to the unraveling that is consistent across the population studied. The unsecured consumer debt products crack first because the immediate consequences beyond a credit score penalty are limited. No one loses their home for missing a credit card minimum payment. So the household protects the mortgage above everything else. It sacrifices the credit score to preserve the roof. What the household does not understand is that the same institution holding the mortgage is watching the credit card delinquency in real time and updating its risk assessment of the mortgage file accordingly. This is the dimension of this story that fundamentally changes how a Canadian homeowner should think about every credit product they carry. In 2026, the data walls between financial products at the same institution are thinner than they have ever been. The bank does not see a credit card division and a mortgage division operating independently. It sees a single customer risk profile updated continuously by behavioral data flowing from every product the customer holds. Or when the credit card division records a missed minimum payment, that information does not stay in the credit card division. It flows directly into the mortgage risk assessment engine. The underwriting that approved Michael and Karen's mortgage in 2022 is no longer the primary document defining their relationship with the bank. Their behavior over the subsequent 24 months has been layered on top of that original approval, and the cumulative picture is significantly different from the one that existed on closing day. Signal 3 is the inflection point, and it represents the last realistic window for meaningful intervention. This is the stage the Bank of Canada researchers described as the acceleration phase. It occurs in the 6 months immediately preceding the first missed mortgage payment. That both credit utilization and consumer credit delinquency increased sharply during this window. The pattern that was gradual for 24 months suddenly compresses. For Michael and Karen, this stage arrived without announcement in the fall of 2024. The credit card balance had reached $7,400 on a $12,000 limit. Utilization was above 61%. They had missed 2 minimum payments in the previous 6 months. Their credit score had dropped from 742 at purchase to 638. They were still paying the mortgage. Every single month, the $4,100 cleared on time. They were holding the line on the thing that mattered most, but the line of credit had been drawn down significantly. The HELOC had a small balance for the first time since they opened it. The emergency fund was depleted. They were now servicing existing debt with new debt. And the mortgage renewal was 14 months away. What happens in the final 6 months before a default is a compression of everything that was building quietly for 2 years. The family is not making bad decisions at this stage. They are making the only decisions that remain available to them. They are triaging. They are paying the mortgage and the utilities and the minimum payments on every other obligation and hoping the situation stabilizes before something breaks. What breaks is typically a single triggering event, a job disruption, a medical expense, a vehicle that cannot be repaired affordably. One event that requires $3,000 or $4,000 at a moment when there is literally nothing left in any account. The credit card hits its limit. The line of credit is exhausted. The checking account cannot cover the next mortgage payment. And for the first time in 3 years of home ownership, the payment does not clear. The sequence that follows is mechanical and operates on a documented timeline. The missed mortgage payment triggers an internal flag within 48 hours. A collections representative contacts the borrower within 5 business days. If the payment is not received and the account is not brought current within 30 days, the file is classified as delinquent in the bank's internal system. At 60 days, the file transfers to the special loans unit. The special loans officer pulls the complete customer profile. They review the credit card utilization history going back 2 years. They see the missed payments. They see the HELOC balance. They see the credit score trajectory from 742 to 638. They do not see a family navigating a difficult period in a difficult economic environment. They see a risk profile that has been deteriorating according to a documented and predictable pattern for 24 months. Their mandate is not to help the borrower retain the home. Their mandate is to manage the bank's exposure and recover the capital with minimal loss. Here is the broader dimension of this story that affects every Canadian homeowner, regardless of their current payment status. The Bank of Canada has made the monitoring of consumer credit utilization patterns a real-time component of its financial stability surveillance. The data flowing from millions of Canadian credit card accounts is aggregated and tracked as a systemic indicator. When utilization rates begin climbing across hundreds of thousands of households simultaneously, the signal does not stay inside the individual risk assessment engines of the major banks. It informs the regulatory posture of the entire financial system. It shapes the renewal terms being offered to borrowers across the market. It influences the stress test parameters applied to new applications. You are not being assessed only as an individual. Your credit behavior is one data point in a collective signal that determines the lending environment for every Canadian borrower. Non-mortgage delinquency rates have surged nearly 29% year over year according to recently published figures. Auto loan defaults have reached levels not seen in over a decade. The aggregate signal is not a warning of something approaching. It is a confirmation that the 2-year countdown is already running for a significant portion of the Canadian mortgage holder population. What should you do with this information? And the answer is specific to where you are in the sequence right now. If your credit card utilization is below 20% and you have not missed a consumer credit payment in the previous 12 months, you are not in the countdown. But this is the moment to build the buffer, not to exhale in relief. The renewal wave is still arriving. The payment shock we documented in our previous investigation is still coming. The financial margin you build today is the distance between you and Signal 1 when the renewal letter lands. If your credit card utilization is currently between 20 and 40% and you have carried a revolving balance for more than 6 consecutive months, you are in the early phase of Signal 1. The bank's algorithm has noted the pattern. It has not escalated yet. The trajectory is established, but it is not fixed. The action required now is to stop the upward climb, not to eliminate the balance overnight, but to stop adding to it. Identify the specific category of spending that is driving the balance upward month over month and address that category structurally. A budget adjustment that reflects the actual cost of living in Canada in 2026 is not optional at this stage. It is the mechanism that interrupts the 2-year sequence before it reaches Signal 2. And if you have missed one or more minimum payments on any consumer credit product in the previous 12 months, you are in Signal 2. The bank already knows. Your internal risk score has already moved. The options available to you 6 months from now will be fewer and more expensive than the options available to you today. This is the window to speak directly with a licensed mortgage professional, not to conceal the situation, but to model what your renewal will look like at your current credit profile and at current market rates. Understanding the gap between what you can service and what the renewal will require gives you the information needed to make a voluntary decision on your own timeline rather than a forced decision on the bank's timeline. So the Bank of Canada spent 9 years and 9 million credit files building the map of how Canadian homeowners lose their homes. They built the map to protect the stability of the banking system, but the map is public. The 2-year countdown is not an inevitable outcome. It is a sequence of observable, measurable behaviors that can be interrupted at any point before Signal 3 closes the window permanently. The credit card in your wallet is not simply a payment tool in 2026. It is a continuous data feed into the most sophisticated household financial surveillance system ever operated by a Canadian institution. Every balance carried forward, every minimum payment missed, every month the utilization rate is higher than the month before. The algorithm is reading the sequence. The question is whether you are reading it first. In our next investigation, we are going to follow the money after the power of sale completes. We have documented what happens when households run out of options and the bank moves to recover its capital. What we have not yet exposed is what happens to the asset after the forced sale. Who buys the distressed properties, where the cash flows, and which category of institutional buyer has been quietly and systematically positioning itself inside the Canadian housing market for the past 3 years in preparation for exactly this wave of forced sales? The answer involves a level of the market that operates entirely outside the visibility of the average homeowner and that the mainstream financial press has almost entirely failed to examine. Subscribe to Canada Property Watch. We read the research that regulators publish for institutions and translate it into the language that homeowners need before the envelope arrives. The countdown has been officially documented. Now you know what to watch.